Now, somebody who's going to hopefully help us to wake up is our next guest, Paul Abrams. He is the co-founder of BreakUpTheBigBanks.com, a website I can get behind. Paul, welcome to the Young Turks.
Thank you very much. Nice to be here.
Great to have you. So I want to ask you about something you wrote, which I think is very important and interesting, which is the concept that we are giving taxpayer money basically through the Fed at a lower rate, and then the banks are loaning it back to us at a higher rate. So I need that explained a little bit better. So tell us how that process works.
Okay. Well, actually, if I said taxpayer money, that was a slight misstatement. Basically, the Fed prints money. They don't actually take taxes in. But what they're doing is through the Fed window, and all of this is terminology, jargon. So let me make it simple. The Federal Reserve, one of its functions is to loan banks money so that they can engage in their normal activities. Those activities are supposed to include providing credit, liquidity, enabling company to meet payroll when their receipts haven't quite come in yet for a particular quarter, et cetera, and giving loans to construction companies to build new buildings and all of that. That's what the banks are supposed to be doing. And the Federal Reserve window was set up so that the banks could go there and borrow money from the Federal Reserve. That's what the Fed funds rate is. And right now, the Fed funds rate is set between 0 and 0.25%. And just looking it up today, if you were a bank and you went to the window, you could take in money at 0.2%. So but the banks, the big banks at least, which are the ones that I'm concentrating on, aren't really using the money for loans and liquidity. That's still an enormous problem in our economy. What they're doing is they're turning around and buying treasury bonds, and that is basically money that are bills that the Treasury puts out in order to pay for the debt. And so those instruments, depending on whether they are 3 months or 6 months or a year, a 6-month Treasury bill is 0.23%, and a 12-month Treasury bill is 0.36%. So that's a pretty simple equation. You can make 0.3 or 0.6 cents on every dollar, 3 or 6 cents on every dollar. Now, that doesn't sound like very much, and as I wrote, if you went to borrow $100 and you made 6 cents, it wouldn't really be worth the effort. But if you're doing billions of dollars that way, as banks do, you can just take the difference as income and then turn around and tell your shareholders how brilliant you've been on managing your business. And the other important point about all of this, and this goes to a lot of what big banking activity is about these days, is that it doesn't create anything. It's financial manipulation. It doesn't create a new drug to treat a disease. It doesn't create a new bridge, a new home. It doesn't provide education for somebody's children. All it does is take a difference of what they call in the financial industry the spread and take that in as profit. And my point was not that we should abolish the Fed window. It should perform a very important function, but that what Congress ought to do is monitor the use of that function so that there's some correlation between what the banks are actually taking from the Fed window and the amount of loans and credit and liquidity that they are providing for the economy, for the people like your listeners who are actually making and doing things of some importance.
Paul, let me break that down for people and tell me if I've got any part of this wrong. So today a major bank could borrow at 0.2% from the Fed. They could then turn around and lend it to you at a lot of different rates. It could be a mortgage at 6%, 7%, 8%. That would be a gigantic spread, 0.2 to 7%, for example. Okay, or they can give you a credit card, and sometimes those get up to 19%, 29%. So they're borrowing at 0.2 and lending it out at 29%. But understand that involves a certain level of risk. That's why they're charging you those higher and higher interest rates. But for what Paul is talking about, for the Treasury, there is no risk. They just borrow at a lower rate, and then they turn around and give it back to the government at no risk at a higher rate. So they can't lose. I mean, and Paul, one, do I have that right? And two, if that's the case, I mean, isn't this kind of why don't we get to do this? Why do only the richest people in America get to do it?
Well, actually, at one point I was thinking that the citizens of the country ought to form into the Bank of the American People and just go to the Fed window and borrow money, and we'd all be rich.
I mean, because it's robbing us to pay us. I mean, it's crazy. So now
again, if it were linked to normal banking activities, and I should say that even in normal times, banks did park their money in some treasury bills, but in this time, when they're borrowing enormous amounts of money from the Fed, and when they are not actually doing what TARP was supposed to make them do, and what this lending facility is supposed to be there for, I think that it's time, long past time, for the Congress to do something about that.
All right, Paul, one last question for you, and it's on that count. Do we have any bill or amendment or anything along those lines that would control the variability here between the Fed window and the Treasury
and what
bonds?
Their activities are? Not that I know of. The only thing that is going on is that the Fed is going to be audited. And I don't know enough about the technicalities of the bill to know if this sort of activity is going to be part of that audit or not. And, if I have a moment to go on to a slightly different but also in the same vein type of point, and that is you've all read about Goldman Sachs, and they're not the only ones who do it, launching an instrument, some kind of a security that investors buy, and then turning around and going short on that. And what that means for people, again, who aren't financially or into the financial jargon, is that they bet that it's going down. So they just sold something to people who are betting that it's going up, and they're betting that it's going down. And they say, we have to do that in order to, equalize the markets and manage risk, quote unquote. By the way, manage risk, every time you hear that, that's a red flag, because what it is, it's an excuse in jargon for taking risks with your life and my life that neither you nor I have given them the permission to take. But so what they do is they bet that it's going down. That's what Goldman Sachs is in trouble for right now in this one particular deal. Well, I've been the CEO of a publicly traded company, and one of the things that we did in this publicly traded company, and almost all of them do it, if not all, is they say that an employee, an officer, or an executive cannot go short, that is, bet against their company's stock price. So Lloyd Blankfein, who runs Goldman Sachs, can't go short, bet against Goldman Sachs stock, but he can sell you something that he then bets against. And that is something that I think needs to be stopped as well. And there is legislation that is pending. It may be actually in one of the bills, though, that you were talking about a moment ago that may go down because of the Republicans, that would, in fact, put an end to something like that. And that is just absolutely outrageous.
Right.
And
well,
I guess,
the Dorgan Amendment would prevent naked credit default swaps, so then he would then blank.
No, but that's one thing. But the other side of it is also selling the security and then going short, betting against, basically assuming that security is going to become valueless. Right. That's what they did with these mortgages before.
Right.
And again, hearing your earlier comments, by the way, it just struck me when you talk about the conservatives and the Republicans and what they should really be for, if they were truly conservative. It seems to me that what they have done is mixed up in the Americans' minds the difference between free markets and laissez-faire. Free markets, if they're really going to be markets, require really good rules so that everybody is playing more or less on an equal playing field. Laissez-faire allows people to have no rules, and as a consequence, those that can corner various markets corner them. And that's exactly the opposite. Adam Smith would be rolling in his grave if he thought that, if he saw what was going on now being called free markets by the Republicans.
Absolutely. Paul Abrams, co-founder of BreakUpTheBigBanks.com. Thank you so much for joining us. Really appreciate it.
And thank you. Bye.
We'll be right back.